Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Lance McGray, managing director and head of ETF product with Advisors Asset Management, to discuss portfolio diversification and how preferreds can fit into an asset allocation mix. Lance, it's great to have you with us. Welcome to Trade Talks.
No, thanks a lot for having me, Jill.
With all the issues facing investors, why is it beneficial to revisit the importance of portfolio diversification?
Well, diversification is key right now. If you think about the current backdrop, and even before, Russia invaded Ukraine, the environment was very challenging. We had rising energy costs, we had supply chain shortages, we had surging inflation, and now you couple that with the geopolitical risks that seem to be mounting, every single day, and the uncertainty is out there, right? The economic uncertainty out there, not only in the short term, but in the future as well, is increasing. And as uncertainty increases, so does volatility. And when we talk about volatility, right, there's a few things that investors can do. Obviously, the knee-jerk reaction is sort of moved to the sidelines. But here at AAM, we really think it's about diversification, right? This is a great opportunity to sit back, look at your portfolio mix, try to understand the risks that you have in your portfolio, and understand the goals that you want to achieve. And from there, you can look at asset classes that are highly uncorrelated and try to mitigate this, navigate around these really, really volatile times. So, with excess volatility in the marketplace, it really comes back to diversification and how you can sort of navigate that volatility from your overall portfolio.
And what are some potential ways to address these concerns?
Well, as I mentioned, I think the initial knee-jerk reaction for most investors, both institutional and retail, is really, liquidate and move to the sidelines. Wait for a little more clarity to come into the marketplace. But as we all know, nobody has a crystal ball. Nobody knows where inflation rates are going, where the 10-year is going, what's happening with earnings or revenues. So from that standpoint, right, it's all about diversification and finding uncorrelated assets. So we're seeing a lot of investors move into the alternative space, whether it's managed futures or market neutral strategies, or even other asset classes like bank loans or real estate, to try to find that uncorrelated returns to sort of help mitigate the risk along the way as we see, these really challenging times. And in fact, today, I think it marks the 13th straight day where the VIX is over 30. So volatility is here. We don't anticipate it sort of, going anywhere anytime soon. So it's really about finding that really, that portfolio mix where you can sort of mitigate those risks going forward.
Another potential way to provide additional portfolio diversification is to incorporate preferred securities into the asset allocation mix. What makes preferreds unique?
Preferreds are really interesting here because by nature of preferreds, they're hybrid securities, right? They're sort of a combination between stocks and bonds. And when you're looking for uncorrelated assets or asset classes, preferreds really, sort of check a lot of the boxes. Historically, we've been in preferreds have been anywhere around 50 to 55% correlation to major asset classes. And this is an area from a diversification standpoint can really help benefit investors, not only in the short term in these elevated levels of volatility, but also in the long term as well, by potentially minimizing your max drawdowns and potentially increasing, risk-adjusted returns. Another benefit of preferreds in this environment is they generally are high income securities, right? So despite the 10-year being north of 210 right now, a lot of traditional fixed income strategies and solutions just aren't meeting the income demand or the needs of investors. And from an income standpoint, given the fact of where preferreds lie on the capital structure, right, they do offer additional income for, rather than their equivalent bonds because of that additional risk. So not only do you get the benefit of diversification, uncorrelated assets, but you're also getting an asset class that is producing a relatively attractive income. And then from a tax efficiency standpoint, the majority of preferreds out there have QDI or pay QDI or qualified dividends. And what that means is that there's a tax efficiency as well. So not only are you getting a very elevated level of pre-tax income, but on a after-tax basis, they're even more attractive. So really a lot of benefits here with preferreds in this very uncertain market, diversification and high income as well.
And finally, Lance, in the last minute here, how does an investor pick the best preferreds for their portfolio? And are they appropriate for all types of investors?
Well, like most investments, there's no one size fits all. And that's certainly true for preferreds as well. What we're thinking here on the preferred side right now is, when you look at preferreds, they are very attractive from the diversification and the income standpoint. But generally speaking, preferreds are longer maturity securities with, in some instances, no maturities at all. And with that said, you can probably assume, and you would be accurate in assuming, that they do carry interest rate risk as well. So with anticipated moving rates, with interest rates moving higher, these securities do tend to be very sensitive to interest rate moves. And for that reason, there's a very unique and a very small subset of preferreds that actually have the ability to minimize your interest rate or duration risk, right? So if you look at preferreds that have sort of variable or floating rate benchmarks, these interest rates or the coupon payments move in line with the underlying benchmark. So in the instances of rates that move higher, you can actually target low duration preferreds where you're getting the benefits of preferreds, the high diversification benefits, the higher income, but you're also mitigating your impact of rising rates in the future. And while this is certainly a daunting task for a lot of investors, if you don't have the resources or the know-how to go through and look at individual securities and look at, the credit risk and the call risk and a lot of other risks associated with preferreds, there are a few very tax efficient, low cost ETFs out there that provide exposure to the low duration preferred market, where an investor can sort of buy an ETF and achieve a lot of the benefits of low duration preferreds in this rather uncertain time.
All right, Lance, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you, Jill.